Hello and welcome to the channel. In this video, I'll be walking you through the steps you must take to become a profitable trader. But before I dive into the video proper, if you're new to this channel, do consider subscribing. Also click the bell icon beside it, that way you get notified anytime I upload a new video. Well, this video is strictly for those who already know how to trade. Knowing how to trade means how to place, buy and sell orders. And if you're totally new to trading and you don't have a trading account, or you don't even know how to place a trade, so I've done a video on that. I'll drop the link to that particular video on the description of this video, so do well to check it out. But if you already know how to trade and your problem is how to consistently make profit trading the market, then this video is for you. And what you need to understand about trading is just like, for example, an auto mechanic. For you to become an auto mechanic, you need to pass through training. You need to undergo training. You need to understand how to fix cars before you can be called an auto mechanic. And the same thing applies in trading. For you to become a successful trader, you need to acquire the skills. You need to acquire the trading skills to become a profitable trader. The proper way to develop yourself as a trader to become profitable is what I'm going to explain to you on this video. So at the end of this video, trust me, you will see trading from a different perspective. If you've been trading and been making losses, you've been trading and been making losses, your losses is far more than your profit. These are the steps you must undergo for you to actually profit as a trader. First, you need to understand and identify the different market conditions in the market. You being able to identify it is the first step to become a profitable trader. I'll explain in detail the different market conditions we have in the market, so that when you enter the chart, when you open your chart and you want to start trading, you actually be able to identify the market condition that is currently ongoing. That will help you a lot. And what you should understand is no matter the strategy you're using, the win rate on a particular market condition differ from another market conditions. That's why it's very important for you to understand and also be able to identify the different market conditions you have in the market. So the second step is, after you have been able to understand and identify different market conditions, the second step is to develop a trading strategy with confirmation. When I say confirmation, I will explain that later. But one thing you should know about trading strategies is that there are lots of trading strategies. There are, if not millions, of trading strategies, and no trading strategy has 100% win rate. That is what you should understand. No trading strategy has 100% win rate. And what gives you money, what makes you profitable in this market is actually the risk management you incorporate into your trading strategy. For you to improve your win rate, you need to develop a strategy with confirmation. Let me explain what confirmation is. Assuming the base of your trading strategy is RSI. Okay, when RSI hits a certain number, you enter. That's your entry condition. You need to probably add a confirmation for you to be able to enter the market. Once it's 90, you need to see another thing, maybe via candlestick. You can use candlestick as a confirmation. You can use market conditions as a confirmation. Assuming you're using a candlestick pattern as a confirmation, is it bullish engulfing or bearish engulfing? So once the RSI hits probably 90 or 80, and your confirmation is when you see a bullish engulfing or a bearish engulfing, that's when you enter the market. That bullish engulfing is the confirmation to the base of your trading strategy, which is the RSI. That's what I mean by you develop a trading strategy with confirmation. I'll give you a detailed tutorial later on this video, but let me just run through what you need to do for you to become a profitable trader. Step 3, which is the most important step, is backtesting your trading strategy the right way. This is one of the most important steps in becoming a profitable trader. When you properly backtest your trading strategy the right way, when you start trading on real account, it can contain your trading emotions when trading on a real account. And backtesting your trading strategy the right way, two things you must establish. One, while backtesting, you need to establish the win rate on different market conditions. That's why it is important for you to be able to understand and identify the different market conditions in step 1. So once you already know this, during your backtesting, first you need to establish the win rate on the different market condition, and whether the base of your strategy is indicator or the base of your strategy is price action. When you trade with that strategy, it will give you different result on different market conditions. So this is what you need to establish first. Then the second thing you also need to establish while backtesting your strategy is a realistic risk to reward ratio. What do I mean by realistic risk to reward ratio? Assuming you risk $5, how much are you pursuing with $5? If you're risking $5 and you're targeting $1, that is a bad risk to reward ratio. A good risk to reward ratio should be at least 1:1, meaning that if you're risking $5, you should be targeting to profit $5. When I say risking $5 means if you risk $5, when you hit your stop loss, you're losing $5, and you hit your take profit, you're gaining $5. That is the least. If you're developing a strategy, this is the least you should be aiming at. A better trading strategy is a strategy that gives you a risk to reward ratio of 1:2, meaning that if you're risking $5, you are targeting to profit $10. You cannot risk $1 and target 10 cents. Assuming your win rate is 80% or 90%, and you use a bad risk to reward ratio, assuming you use a bad risk to reward ratio of 10:1, you're risking $10. This means that you're probably risking $10 to profit $1, and your win rate is 90%. You still make losses on the long run. You still be incurring losses, because why you should be incurring losses is that for this you need to take 10 trades to make $10. And if you win 9 trades, assuming with this risk to reward ratio, if you win 9 trades and lose 1 trade, 9 trades will give you $9. Losing 1 trade is $10. You are already on a loss. That's why it is very, very important when backtesting your strategy on a demo account. Once you establish the win rate and you establish the risk reward ratio, you already know what to expect when you start trading real account. This will reduce your trading emotions when you lose a trade on a real account, because you already know what is going to turn out to be. And the last step is start trading with real money. So what you need to do here is you have to do this on a demo. This is what you do on a demo. Whatever result you get on a demo is the exact same result you're going to get when you're trading on a real account. So now I'll go into details. I'll take you to the chart. Let me show you how to understand and identify the different market conditions, and also teach you a strategy with a risk reward ratio of 1:2 and with a win rate of up to 50%. So with this win rate and risk reward ratio, you're sure you're going to make profit on the long run. It's not all about win rate. Trust me, you can have a 30% win rate. With the right risk to reward ratio, you'll be making profit. What can improve the win rate is the confirmation you incorporate to your trading strategy. That will improve the win rate. And also the risk to reward ratio. With a higher win rate and a very good risk to reward ratio, you're sure you'll be making profit on the market. So now let me take you to the chart to show you how you can understand and identify the different market conditions, and I'll be giving you a free strategy, as I said earlier, with a risk reward ratio of 1:2 and 50% win rate. So let me explain step 1, which is types of market condition. The first type of market condition in the market that you always see in your chart is called the volatile market condition. How do you identify a volatile market condition? One thing you should understand that the volatile market condition, there are 2 types of volatile market condition. The first one is upward volatile market condition and downward volatile market condition. How do you identify these types of market condition? Let me show you. For an upward market condition, assuming this is your chart, it goes like this. This is the price chart. In volatile market condition, it makes visible high, higher high, higher high, and also visible higher low and higher low, higher low, higher high, higher high, and higher high. So this is a typical example of an upward volatile market. So an upward volatile market, you notice that the price movement keep making visible higher highs, higher highs, higher highs, and higher low, higher low, higher low, and it's going what? Upwards. That's why it is an upward volatile market condition. The downward volatile market condition is just the opposite of this. Assuming this is your chart, when you see something like this, so a downward volatile market condition makes visible lower high. This is a lower high, this is a high, this is a lower high, this is a lower high, and this is a lower low, lower low, and lower low. So this is just an opposite of this. So a downward volatile market condition makes visible lower high, lower high, lower high, and lower low, lower low, lower low, and it moves downward. It faces downward. That's why it's called downward volatile market condition. So let me take you to the chart and show you how to identify an upward and downward volatile market condition. Okay guys, as you can see on your screen, from here to here is a typical example of an upward volatile market condition. Why is it an upward volatile market condition? Because it's making an upward trend, and as you can see, you see that it's making a reasonable higher highs, higher highs, higher highs, higher highs, which is always above the previous high, and is making visible higher lows, higher lows, higher lows, higher lows, higher lows. So when you see something like this, this is a typical example of an upward volatile market condition. So this is a typical example of a downward volatile market condition. From here, from here to here is a typical example of a downward volatile market condition. If you see, is making a reasonable, this is a high, this is a lower high, this is a lower high, is making reasonable lower highs and lower lows. This is a lower low, this is a lower low, and this is a lower low. So when you're trading, that is how to identify a downward volatile market condition. So the second type of market condition we have is the non-volatile market condition. And under non-volatile market condition, we have the upward non-volatile market condition and the downward non-volatile market condition. How do you identify this type of market conditions? For an upward non-volatile market condition, this is what you see. The price keep moving like this. So the price of the asset keep moving like this. It does not make visible higher highs or higher lows. It moves towards an upward direction. For a downward non-volatile market condition, it's just the opposite of this. The price will be moving like this, facing downward. It will not make visible lower highs and lower lows. So this is a typical example of non-volatile market condition. So let me take you to the chart to show you how you can identify this type of market condition on your chart. So guys, as you can see on your screen, this is a typical example of an upward non-volatile market condition. From here to here is a typical example of an upward non-volatile market condition. As you can see, it's not making any reasonable higher highs and higher lows. So when you go to your chart, if you see something like this, just know that the market is exhibiting an upward non-volatile market condition. So the third type of market condition we have is the volatile ranging market condition, and this is how you identify a volatile ranging market condition. When the price of an asset is moving in this direction, you notice that the resistance level is almost the same with all the highs, and the support level is almost the same with the lows, and it's moving horizontally. This is a typical example of a volatile ranging market condition. Is ranging, is neither going up or going down. So when you see something like this, you should know that this is a volatile ranging market condition. The win rate you achieve on a volatile ranging market condition cannot be the same with the win rate you will achieve on an upward or a downward volatile market condition. So that is one thing you should have in mind. So when you're backtesting your strategy, these are the things you should take note of. You backtest on a volatile ranging market condition, you backtest on an upward or downward volatile ranging market condition, you backtest on an upward and downward non-volatile market condition. So once you do that, you notice that at a certain market conditions, you always achieve a higher win rate. Yeah, okay guys, as you can see on your screen, this is a typical example of a volatile ranging market condition. From here to here is a typical example of a volatile ranging market condition. It has similar resistance level and same support level here. So from here to here is a volatile ranging market condition, and also from here to here is also a volatile ranging market condition. If you see here, it has equal resistance levels and equal support levels. So from here to here is a volatile ranging market condition. When you go to your chart, this is how to identify a volatile ranging market condition. The last type of market condition we have is a non-volatile ranging market condition. And how do you identify this type of market condition? So when you go to your chart, you notice, assuming this is a candlestick, you notice that the first candle is this candlestick, the second candlestick, third candlestick, fourth candlestick, fifth candlestick, and so on, sixth candlestick, and so on. So you notice that the candlesticks are moving in a horizontal direction, having the same resistance level and support level. So when you see something like this, you know that this is a non-volatile ranging market condition. It's ranging, but it's not volatile. Let me take you to the chart to show you how you can identify a non-volatile ranging market condition. This is a typical example of a non-volatile ranging market condition. From here to here is a typical example of a non-volatile ranging market condition. As you can see, each candlestick is aligned horizontally, having the same resistance level and support level. This is a typical example of a non-volatile ranging market condition. The same thing applies here. Is non-volatile ranging market condition. The same thing, non-volatile ranging market condition. This is how to identify a non-volatile ranging market condition from your chart. So that's all for step one. I believe by now you should be able to identify all the types of market condition. So moving over to step two, and step two is developing a strategy with confirmation. I've already explained this before in details. Let me just throw more light on it. As I said earlier, that we have lots of strategy. We have more than 1 million strategies in existence. You can either develop a strategy using indicator, you can develop using price action, If you're trading currency pair, you can develop using fundamental analysis. It all depends on you. If you're using an indicator, make sure you attach confirmation. Confirmation will help improve the win rate of whatever strategy you are using. And I've explained what confirmation is. So, and I told you in this video I'll be teaching you a strategy that has up to 50% win rate and a risk to reward ratio of 1:2. So the strategy I'll be teaching you is price action, and our point of entry will be higher highs, higher lows, lower highs, lower lows, lower lows, support and resistance. And how are we going to confirm this? We are going to confirm it using non-volatile market condition. You can also call this consolidation. That's a non-volatile consolidation. We're going to use this as a confirmation, and this is going to be the basis of our strategy, our trading strategy. So once we see a higher high, higher low, lower high, lower low, or support or resistance, that will be a signal of entry. But before we enter, we need to confirm it first by seeing a consolidation. So that's the strategy I'm going to teach you, and with this strategy we are going to achieve a 50% win rate, and we are going to achieve a risk reward ratio of 1:2. So let's move over to step 3, where I'll show you how to trade with this strategy. I'll give you all the details you need to trade this strategy effectively. So step 3, what we are going to do is to backtest the strategy I just told you about. And while we are backtesting the strategy, we are going to establish the win rate. We are going to establish the risk to reward ratio, a realistic risk to reward ratio. So let me take you to the MT5 chart. We'll be doing this using the mobile version of the MetaTrader 5. Okay guys, we are now on the phone version of the MetaTrader 5 platform, and as you can see, okay, this is a volatile trending market. Remember guys that I said what we are going to be trading is support and resistance zones, lower low, lower high, higher low, and higher high zones. So that's what we're going to be trading on this strategy. And currently, as you can see on your screen, is making lower highs and lower lows. And remember I said that what we're going to use to confirm our entry is when we see a non-volatile consolidation. That's a non-volatile ranging market on those zones. So once you see it, that's when you enter the market. So this is a typical example of what I'm saying. Currently it's consolidating here, which happens to be a lower low zone. So this is how we're going to trade it. I'm going to enter at this point of the consolidation at the tip. Remember, it's a buy position. If it's a buy, it must be at the bottom of the candlestick. Your entry must be at the bottom of the candlestick if it's a buy order. So to calculate my lot size, I'll use the crossbar tool. As you can see on your screen, I'll pick the resistance and the support of that consolidation. So once I pick the tip, this resistance level and the support level of that consolidation, then I'll now use it to calculate my lot size. Remember, I want to risk $2 on this trade, and I'm using $2 to pursue $4. The risk reward ratio, remember, is 1:2. I'll wait for the price to reach the support level of this consolidation before I enter the market. If you cannot wait to monitor, then you can set a pending order, a buy limit. A buy limit, once you get to that point, it will trigger a buy trade and you start reading. Once you have used your crossbar to pick your entry and your take profit level, what you need to do is to copy the corresponding number here. That's the second number. This number is what you use to calculate your lot size based on the amount you want to risk. So I want to risk $2 on this trade, so this is what I'm going to do. This I'm going to calculate it. I'll pick this number, I'll divide this number by 2, After dividing it by 2, then I want to raise $2. Then I'll say 2 divided by the number. So whatever it gives me is the lot size. But because this is step index, whatever number it gives you, divide it further by 10. So whatever it gives you is what you use as your lot size. That way, once it hits your take profit, you're gonna get double of whatever you risked. Because I'm risking $2, I'm gonna get $4 immediately hit my take profit level, and my stop loss will be half of the distance between my entry and my take profit level. So to calculate my loss size, I've already shown you how to calculate my loss size. So my loss size is 0.133. Since the price is yet to hit this level, that's my entry level, what I'm going to do is I'm going to place a buy limit. Once I place a buy limit here, when the price gets to that level, it will trigger a buy trade. Because this is the level I'm going to take my take profit, and also use the distance between the take profit and the entry. Half of it, I'll use it and set my stop loss. I'll go ahead and do that now. Okay guys, as you can see, I have placed a buy trade just below the support level of this consolidation. So I'll go ahead and set my stop loss and take profit using the corresponding number here as my take profit. I'm done adding my take profit. So now let me add my stop loss. To add my stop loss, remember the distance between the entry and the take profit is 3. To set my stop loss, I'll need to divide 3 by 2. Dividing 3 by 2 will give me 1.5. So I'll now measure from my entry point downwards. I'll measure 1.5. The corresponding number is what I'll use as my stop loss. So I'll do that now. Yeah, I'm done adding my stop loss. As you can see on the screen, you see my stop loss level and take profit level. Remember, the distance between my stop loss and the entry level is half the distance between my take profit and my entry level, so take note of that. So after some minutes, I'm back to the trade. As you can see, it has reversed and is about to hit our take profit. So I'll keep monitoring it. In order not to make this video to be too long, I will come back to the trade after it hits the take profit. Okay guys, I'm back to the trade. It has already closed on profit, $4 profit. One good thing about this strategy is that if you lose one trade and get one trade, you'll be on profit. As you can see on your screen, I'm on profit of $1.85. I'll take more trades. Let's see, I'll check all the opportunities and take all the trades I can see today. Okay guys, I'm taking this trade. As you can see, it's making lower highs and lower low, and currently it's consolidating, anticipating to go up. So my entry is at the base here, so at the support level of that consolidation. Okay guys, my lot size is 0.14 and I'm risking $2 with a risk to reward ratio of 1:2, as you already know. Okay guys, this is another opportunity. Volatility 10 index, as you can see, is consolidated on a support zone, so anticipate it's gonna go up. So I'm gonna trade this based on the strategy I just explained to you earlier, with a risk to reward ratio of 1:10. And at the end, I will show you the result of all the trades I'm placing. This is the fourth trade. Okay guys, this is another opportunity here. Volatility 75 index, as you can see, is consolidating, and this is a volatile ranging market, so I'm anticipating it's going to come down. So I'm going to enter a sell position. So, and this is going to be my entry. I'm going to enter here, and my take profit is going to be here. Yeah, okay guys, I'm done for the day. This is total of 7 trades. 7 trades, 3 close on profit and 4 close on loss. And as you can see, I ended up making profit. That's one good thing about this strategy. In as much as I failed first trade and I got 3 trades and I'm still on profit, that is how to trade. As you can see, I made a profit of $2.99, almost $3. I made profit almost $3. And just in case you send me a WhatsApp message, you ask me a question and I don't respond immediately, just bear with me. So if you want to ask, just make sure you type all your questions down so that when I'm answering whatever question you have, I can be able to answer once, because I have a lot of messages coming into my phone. I might not have all the time to reply you promptly on each message, so just bear with me. But one thing is, I'll try and reply everyone that send me a WhatsApp message. If you have any further questions, maybe if you don't understand how to calculate your risk or how to place your buy stop or take profit, always let me know. I will try and explain more.